Today, we're tackling a really big one. That huge CEO compensation package proposed at Tesla.
Right. Big numbers, lots of discussion.
Exactly. But we're not just rehashing the debates. We're taking a specific angle. We're looking at it through the lens of, well, one very significant investor, Baron Capital.
That's the plan. See, when an institutional player like Baron Capital, managing, billions, publicly backs a package this size, their reasoning matters a lot.
It's not just noise.
No, definitely not. It's almost a case study in how certain large investors think about value, risk, and leadership in these, well, highly disruptive companies. So our mission today is really to unpack Baron Capital's core arguments for endorsing Elon Musk's 2025 CEO Performance Award. What's their actual logic?
Okay, let's get into it. Their main statement is, well, pretty direct. They came out saying they believe this award is, and I'm quoting here, right for the company, right for shareholders, and right for the future.
That's putting a strong stake in the ground. Very confident language, especially
Yeah.
given, the volatility around Tesla sometimes.
So where does that confidence come from? You mentioned their history.
Yeah, that's the foundation. Baron Capital isn't new to Tesla. They first invested way back in 2014.
A decade. So they've seen the whole arc, more or less.
Exactly. They have that 10-year perspective on the company's growth, its challenges, and crucially, Musk's leadership style. And they lean on this history heavily in their argument now.
How so? What's the connection they make?
Well, they state very clearly that their own shareholders, their clients, have benefited enormously directly because of Musk's vision, his determination, and his execution over that decade.
So it's an argument based on track record? Look at the returns we've already gotten, they're saying.
Precisely. It's like saying, we trust this approach because it generated massive value for us in the past. It uses historical success to sort of validate the current decision.
And they position this new 2025 award package not as something radically new, but continuation.
That's the framing. They argue it's driven by the same core principles, accountability, hitting really tough performance targets, and making sure leadership interests align with shareholder interest. The very things they credit for Tesla's past wins.
So in their view, they're just re-upping a successful formula.
Kind of. They'd say they're renewing the contract, the understanding. That worked before.
But okay, if those principles were working, why the need for such a, well, dramatically larger award this time? Does that suggest the old setup wasn't enough anymore? Maybe for keeping him.
That's the implicit tension, isn't it? Baron doesn't quite say that, but they do focus heavily on retention. They actually praise the board for acting decisively to keep hold of Tesla's most valuable asset.
Most valuable asset. Strong words for a CEO.
Very strong. And it implies the focus has shifted, at least partly, towards ensuring stability. The goal, they say explicitly, is making sure Musk stays at the helm for, quote, many years.
So the award isn't just about future performance, it's insurance, keeping the key player in the game.
That seems to be a major component of their thinking, yes. When you call your leader your most valuable asset, you're signaling something about perceived dependency.
Okay, let's talk alignment then. They really hammer this point. How does the plan ensure, as they claim, that shareholders win first?
Well, the first connection they draw is to Musk's existing ownership. He already owns about 13% of Tesla.
Right, significant skin in the game already.
Exactly. So Barron argues his baseline interests are completely aligned with investors, just from that stake alone. But the new award really doubles down on this.
How? It's not just cash, right?
No, not at all. It's structured entirely as stock options, a massive tranche of them.
And these aren't just any options, I assume. What makes them align interests?
They're vesting conditions.
Yeah.
The options are essentially worthless unless the company achieves some truly staggering milestones. We're talking about huge operational targets, yes, but also market capitalization goals.
Like how big?
Well, the targets push Tesla's market cap deep into the hundreds of billions, even potentially over $1 trillion. It's extreme.
So he only gets the benefit if all shareholders see massive gains first.
That's the core mechanism Barron points to. It's not just pay for performance, it's pay for extraordinary performance that lifts the entire company's value dramatically. His 13% is the foundation, and these options only pay out if that foundation grows enormously larger.
Okay, so that's the technical argument for alignment. The structure forces shared upside. But their justification goes beyond just the mechanics, doesn't it? They build him up quite a bit.
Oh, absolutely. They don't just talk about him as a CEO. He's painted as a visionary who built, in their words, one of the most important companies in the world.
And created value while doing it.
Yes, lasting value for shareholders, but also significantly redefining multiple industries along the way. It's a much broader claim. They're suggesting they aren't just compensating a CEO, they're investing in a multi-sector disruptor.
Which I guess leads us directly to their biggest, maybe most critical point, this idea of key man risk.
This is absolutely central to their whole argument. It's where the rationale shifts from performance and alignment to something more like dependency, existential dependency almost.
And the phrase they use is really striking.
It is. They call Elon Musk the ultimate key man of key man risk.
Wow. Okay, let's break that down. What does key man risk normally mean for investors?
So typically, key man risk refers to the danger a company faces if it loses a critical individual, someone whose skills, knowledge, or leadership is just fundamental to the business's success. Losing them could seriously damage the company's value, its operations.
When companies try to mitigate this, right? Succession planning, insurance.
Exactly. Standard procedure. But when Barron calls Musk the ultimate key man, well, that implies something much more extreme.
What's the implication there?
It implicitly suggests two things. One, that a significant portion of Tesla's current market value is tied directly to his presence and leadership, maybe even inflated by it. And two, that standard mitigation like succession planning might be, well, insufficient, or maybe even impossible in this case.
So the enormous compensation package isn't just a reward. It's framed as the only effective mitigation. A very expensive insurance policy against a potential collapse in value if he leaves.
That seems to be the core logic, yes. It positions the payment as a necessary cost to avoid a potentially catastrophic financial outcome.
That's a heavy claim. Total dependency. How do they back that up? What specifics do they point to?
They don't mince words. They argue that without his specific leadership style, what they call his relentless drive and uncompromising standards, there simply, quote, would be no Tesla.
So it's not just about the future, it's a judgment on the past, too. He was the indispensable ingredient.
Yes, and they apply that same logic going forward. It's an argument that basically bypasses questions about, say, the strength of the executive team or the company's institutional resilience. It focuses entirely on him.
And they broaden his current impact beyond just cars, right? To justify this indispensability now.
They do. The source highlights his work in redefining currently 3 major fields simultaneously. Transportation, obviously, but also energy and humanoid robotics.
So the message is, this isn't just one company's CEO. This is someone driving change across multiple frontiers at once.
Right. And the subtext is that this kind of multi-pronged innovation leadership is unique, perhaps irreplaceable through any normal corporate process, which again circles back to justifying the extreme cost of retaining him.
So wrapping that section up, Barron Capital essentially sees this huge package as a critical, necessary expense. It's about managing what they view as an unparalleled existential risk tied to one single person.
It's absolutely framed as a defensive necessity, not a bonus or a gift. A strategic cost undertaken to protect their investment by keeping the perceived engine of value creation, Musk himself, locked in.
They're betting that the cost of the package, however huge, is less than the potential financial damage of losing him.
That's the calculation they're presenting, yes.
Yeah.
It's all about minimizing the perceived downside of this ultimate key man risk.
It's definitely a fascinating look inside the thinking, the narrative construction of a major institutional investor facing a really unique situation. They're using history, structure, and this concept of existential risk very strategically.
Absolutely. If you boil down their message for the listener, Barron's endorsement is really all about value preservation through leadership continuity.
Keep the magic going.
Essentially. They argue Musk's leadership is the indispensable catalyst, that's the key word, catalyst for the shareholder gains they've seen and the future disruption they expect. So retaining that specific catalyst becomes the paramount strategic goal for a long-term investor like them.
Which leaves us with a final thought, maybe a question for you to consider based on what we've unpacked from Barron's perspective today. If a company's future value, its potential for groundbreaking innovation, truly rests so completely on one individual, this ultimate key man, does paying that individual an enormous sum actually solve the underlying risk? Or does the very fact that such a payment is deemed necessary just highlight how profound and unresolved that fundamental dependency risk truly is for the company's long-term future?